Good afternoon, everyone, and welcome to the CME Group's webinar on charting and analytics of precious metals. My name is Anthony Cohen, and I'm the head of application specialist for the Asia Pacific region at CQG. When we think of precious metals traditionally, we think of gold and silver. Both are very special instruments when it comes to trading, and gold even more so than silver. Everybody knows that both metals are heavily used in the domain of jewelry, but technically the world does not need much of gold in the industrial domain. Silver, on the other hand, has a lot more properties that makes it crucial for industrial developments such as solar panels or nuclear industry and so on. Yet ties are strong between those two contracts to the point that the spread between the two has become a benchmark. The feeling is that they're both a sort of barometer of the world's economy's health than actual commodities. That status means that prices in these instruments can be very volatile at times. The volatility also means that certain types of traders might be finding it difficult to trade using standard tools. Standard analysis still widely uses time when it comes to price projections, and trend analysis is definitely difficult when data series are showing a mix of linear and non-linear moves. These moves distort indicators' values to a point where they can become almost useless. Although there are a few more, let's review what the two main types of trends we usually encounter. A linear trend is observed when the line that appears to best fit the set of data is a straight line, as opposed to a curved line. Whether it's upward, downwards, or straight makes no difference. In technical analysis, we allow a certain degree of approximation. An exponential trend fits numbers raised to an exponent, meaning a set of values that raise in a very rapid manner. Let's look at a 5-minute chart of gold. Area number 1 shows a period of sideways activity, followed by a small downtrend in area number 2. Areas 3 and 4 show characteristics of exponential trends, followed by area 5, another linear trend, finishing with another area of sideways price action in number 6. The solution to transform charting into a more manageable data series is to use more linear chart types. To do so usually means removing the time aspect in the data. There are a few examples of more or less linear data series, such as point and figure, constant volume bar, T-flow, Ranco, and range bar. We're going to start with point and figure. Instead of plotting price over time, these charts plot the changes of direction in price on a graph-like grid. The grid shows a column of X's as the price rises, followed by a column of O's as the price falls. The change in columns is determined by how many ticks the price pulls back in the opposite direction. Constant volume bars, or CVBs, are bars built based on actual traded volume, or tick volume if actual volume is not available. Tick volume simply records the number of transactions rather than the volume transacted. Each bar in a constant volume bar chart contains a specified volume level. This volume level is reached by accumulating the volume or ticks of each of the underlying bars. When that level is reached, or when a new session begins, the next constant volume bar begins to accumulate volume from the underlying bars. We can see that the chart is more geometric, but there are occasions where the bars are either one tick wide, like here, which is when high volume orders are being executed, and others when we have bars with several ticks wide, which occurs when small volume executions or when prices gap during high volatility. T-flow charts are built from depth of market, or DOM data, and show the accumulation of trades done on either the bid or the offer until that bid-offer price relationship changes. Ranco Chart is a chart constructed of bricks that indicate price movement as a way to help expose trends and support and resistance levels. A brick is created each time the price exceeds the top or bottom of the previous brick by some amount, which is set in preferences. They show a perfect representation of linearity. However, due to the way they are constructed, there can be some challenges using them for backtesting. The reason is that the default setting for this chart is to not display the wicks, which are these lines above or below the body of the brick. As we can see here, the high of the Ranco bar, including the wick, did go much further up than the Ranco body, but did not go far enough to create a new bar. So by not displaying the wick, analysis might show that you could still be in a trade, even though in reality you may have been stopped out. All these charts are more linear than time bar charts because there is no longer time as a parameter. But still, due to the fact that swift or aggressive moves can distort the size of a single bar, means that this is not 100% perfect. The chart we're going to focus on is range bar. Range bar chart is constructed of bars that indicate price movement as a way to help expose trends and volatility. A bar is created each time a trade occurs outside of the previous bar, and the bar range is what you set in the preferences. These characteristics are what makes this chart the most linear and tradable of all. Ranco charts are very interesting, but it is difficult to use them due to the hidden wicks concept. So how does this make this chart type more interesting? The distortion created by swift moves on a timed bar are now represented linearly. Periods of inactivity are eliminated. Indicators such as RSI, moving average, etc. are less reactive and provide better signals. The ability to know when a potential new bar will be built, because we know that a new bar is created on the breach of the previous one. And the ability to project certain indicators' value in advance. Let's take our first example again and look at each section on both chart types. Area number 1 shows micro trends within a bigger channel that is now easier to see. The shape is relatively similar, but looking a lot more manageable on the range bar chart. Area number 2 doesn't show much difference as they're, as we said, linear already on both charts. Area number 3 is quite interesting because it offers more interesting characteristics. On a normal bar chart, it's difficult to establish when that upward move is going to be over. And traders that are long during that period of time are tempted to take profits way earlier because the volatility is a lot more obvious on a normal bar chart. Whereas range bars just show a continuation of an uptrend at the same pace. Area number 4 corresponds to the beginning of it corresponds to the exit of the sideways channel and looks a lot more clear on the range bar. Just like number 2, number 5 is as interesting on both charts, but the last one is a lot more interesting. The area number 6, which looks very volatile on a normal bar chart, shows many smaller trends within it. These trends are by no means easy to trade, but this is definitely painting a different picture when we're looking at them on a range bar chart. So even though they're using the same data, they look completely different. In terms of technical indicators, let's look at another example on silver. The top chart shows a 5-tick range bar, while the bottom is a 1-minute traditional bar chart, both with moving averages of the same parameters. The advantage of this chart is that it eliminates the periods of inactivity from time-based charts. By doing so, it avoids taking unnecessary trades like we're seeing it here. On a conventional 1-minute chart, there are no less than 8 signals generated by moving average crossover systems, whereas the range bar has condensed it into 2 bars. Now we're looking at automated trend channel on gold, and we can see that the data looks a lot more geometric and more analyzable. And last, the same thing on silver, where there's also more opportunities. This concludes the presentation, and I would like to thank you all for your time today. Thank you.